Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. And today we want to look at our series. We want to continue with our series of advanced financial management. And in the previous videos, we had spoke about the gearing, and I had promised you that I will look at the gearing based on market values. But I want you to note something small, that the formulas here are not going to change. What is only going to change is the fact that instead of us using the historical values, we are basically focusing on using the market values. What that means is that they will give you, like for equity, we know the tradable items. These tradable items, they are preference shares, the debentures, if they are bonds, if they are loan notice, and others. Of course, we also have the ordinary shares. Now, these ones, they will always give you what we call the market price per share. If they don't give you the market price per share, you know how to get the market price per share. They may give you the par value of the asset, of that item. They tell that this preference share had a par value of this. Then they give you the total amount. Of course, you'll be able to know. If they give you the total amount, you can actually be able to know the market price. But most of the times they may give you the market price. I'm not going to do a quick broader number to explain this, but I just want you to highlight on the key things that you should expect if it happens. So what they do in this one, they will give you the market values. So instead of using the other values that they have given you, you make sure that you compute what we call the market capitalization. Market capitalization. In other words, you compute the total amount. So this is going to be the MPS, the market price per share times the number of shares. So if they give you, if you want to get the number of shares, of course you know how to get the number of shares. You'll get the amount that they have given you divided by the par value. Then you multiply by the market value. So that's what I'm meaning. After getting the market values, of course, you multiply it by the number of shares to get the new market capitalization that you are going to use in computation of the thing that you are going to put in, either the prior charge capital or the equity component. So that's basically what is supposed to be done from that perspective. But what I want to start with for today is the fact that the other time we spoke about two things. The risks, we spoke about the financial risks that, and those resulted into what we call financial gearing risks. But we also talked about things to do with the operational risks. So we want to look at how do you compute the operational gearing. So this is the second phase. The other one, we have been talking about what we call the financial gearing. So we want now to look at the operational gearing. And this is a second part. All this is because we say that there are two risks. We are going to either have financial risks or we are going to be having what we call operational gearing. And we got this from the other topic where we looked at the cost of capital and the gearing. We say there are two things that will result in once the company is geared. Either we are going to have financial risks or we are going to have operational risks. And the operational risks gave birth to what we call the financial gearing. Then the operational risks gave birth to what we call the operational gearing. So I want to look at what will be the impact of the cost of capital in the sense when it has resulted into what we call operational risks. So that's what we want to look at. Now, we need to first understand what operational gearing is. Now, operational gearing Operational gearing has very many formulas, but there is one that looks at the modern financial management, because there is what we used to cover in the past and what we are financial management is a little bit evolving, and what we used to look at in the past years is not the same thing that we are looking at with given the fact that industrialization came into existence. There are very many industries. So financial management also keeps on changing. So we used to have the operational gearing that was not in considering what we call the fixed costs. By then, we were not looking at the fixed costs. But because now if you are insisting on the operational costs, that those are the costs that are incurred whether you are producing, whether you are not producing. If you look at that, but the whole interpretation by the examiner, it came out to be the same. Those who do it in a previous aspects, or those who do it in the different methods that we are going to be looking at to compute what we call the operational gearing, the examiner has concluded that the implications are going to be quite the same. So we are going to have different scenarios on the interpretation. So, but now what you need to know is that recently the examiner looked at what we call the fixed costs. But operational gearing will be if we are to basically look at what we call the operational gearing, the formulas, we have what we call the contribution. You know, contribution divided by profit before interest and tax. Profit before interest and tax, or what we call the PBIT. Profit before interest and tax. Of course, this one you multiply it by 100 to make it a percentage. However, operational gearing responds to what we call business risks. And business risks looks at more of low profits or losses, depending on the nature of the business. So how do we measure the business risk, or how do we measure the operational gearing? Because we say that operational gearing bases or responds to what we call the business risks. Because those business risks, they are more concerned when the company is making low profits or losses. So the way we measure is we get the contribution and we divide it with profit before interest and tax. How do we get contribution? We know contribution is gotten from sales minus variable costs. In other words, we get the total sales revenue minus the total variable costs to be able to get the total contribution. If they give you the contribution per unit, then of course you know it has been gotten from getting the selling price minus the variable cost per unit. So if they give you the contribution per unit, you just know that you are supposed to multiply by the number of units to be able to get the total contribution. So here we use the total contribution. Maybe to put it here, you know that it is from sales minus variable costs. That's how we get the contribution, sales minus variable costs. And we divide it by the profit before interest and tax. Of course, that's the operational profit. You know, the operational profit doesn't include or doesn't allow you to expense interest, because we know interest is going to be a financing cost. So the profit before interest and tax, that is the profit you have achieved before you pay off the people who financed the operations. Remember, we finance operations using debt. And the reason as why we take off interest is because interest on the money that we have used in the operation of the business is tax deductible. So here we don't first exclude it. Reason being, we want to look at what was the profit that we have got before paying off the people who gave us the money, and even before paying off the tax, because the tax is just a statutory obligation you are supposed to pay. It's by law. But in other words, we can't treat it as a normal expense of the business because it is not as a result of the operations of the business. If I make a loss, I'm not paying profit. I'm not paying taxes. So that's the implication. That's why we are taking the profit before interest and the tax. So if you get these financial statements, you can be able to get this information. We know that all this is supposed to be gotten from the income statement. So you are supposed to be given an income statement for you to be able to compute this analysis. It is from the operations, and the operation is within the performance of the business. If the business is not performing, then we don't have anything to do with operational risks. These operational risks, they are just affecting they are just affecting the profit that you should get. Otherwise, they don't look at the whole entity, but they look at the operations, whether you are able to make profit or not. So we get that problem. So we want to look at the money that we use to finance these operations. Are they making something? That's basically what we are trying to look at. So we look at the risks that are associated with the kind of operations that we are going to be dealing with. So let's now look at something else that is also going to help us address the same concern of risks in the business. We can also do that by looking at what we call the interest cover. So interest cover, we can call it a ratio. Interest cover ratio, because it is always given the number of times. Now, the other method that we can use to measure what we call operational gearing, if you don't use the other formula of getting the contribution divided by the profit before interest and tax, we can use the interest cover ratio. And this interest cover ratio is going to be the profit before interest and tax divided by the interest expense. So this is what we use to measure what we call the operational gearing, and we use what we call the formula is gotten by you getting the profit before interest and tax divided by the interest expense or the interest charge, stock expense. So the interest expense will be given to you. So the interest, of course, this is always in number of times. In other words, here I want to see how much the operating profit, of course this is the operating profit, how much of this operating profit you are going to generate. If we see that we have generated such and such amounts, the next question we ask ourselves, is this operating profit, is it enough to cover the interest expense? And if it is enough, in how many times? Like the interest expense can be 2 million. But we have made maybe the profit before interest and tax of, let's say, 20. million. So if you divide the 20 million divided by the 2 million, you'll find yourself having 10 times. In other words, if you are to pay the debt holders, the profit you have earned can pay them 10 times the interest you are going to be paying to them. In other words, it checks whether you are capable of paying your debt people, the people who have given you the money that you are using in the operation of the business. So what is the bare minimum? Of course, these are we learned this in financial ratios. We looked at them under ratio analysis, and we said that, of course, if you are doing well, if you are doing so well in the business, we expect that the interest cover should be higher than 3 times. If you are doing well, we expect that at least you can get more. In other words, we expect if the interest expense was 2 million, we expect you to have at least the profit of more than 6 million. So it is going to be 3 times the profit, the interest expense. That is going to be 6 million. So we expect you to earn more than, at least, for you to have 6 million and above. If you are using the money, where that money you are using in the business, you are paying 2 million as interest, you should at least earn 6 million and above for you to say that you are doing well. So if you find yourself the number of times your interest cover is, in other words, the interest cover in a nutshell, it is just looking at how many times can you be able to cover your interest expense using the profit that you have earned. And this profit you have earned must be before paying off the interest. That's why we are using the profit before interest and tax, because that is the operating profit. And that operating profit is gotten from getting the gross profit minus the operational expenses, only operational. So these are the other way you can look at it. If you put it in a percentage, because it may be given to you in a percentage and you say, Charles told us it is going to be in times, they can give it to you in percentage. So if they give it to you in percentage, then it should be more than 100% if it is a percentage wise. But just note, it doesn't have a unit. It's supposed to be in times. If they put in a percentage, it is okay, but it's a ratio. So if it is below 100%, then the company is not okay. Of course, if they give it in a percentage, sorry, it's supposed to indicate something, because if you are close to 100, no, actually, if it is in a percentage, then it's supposed to be lower, because the whole argument is that if the interest is 2 million and I have made a profit of 2 million, are you not seeing that it is going to be 100% net, which is actually one time? If I've made a profit of 4 million divided by the 2 million, if you multiply by 100, I want to be at around 50%. Reason being, I'm able to pay twice. So the lower, the better. Because if it is lower, the implication is that the other number of times are many. So let's look at the debt ratio or debt to equity ratio. Most of the times we don't talk about the debt to equity ratio, because we know that debt to equity ratio or the debt ratio is actually covered on level 2. That's why we ignore it, but I want to talk about it because it's one of the method that we can use, but most of the times we don't talk about it. The debt ratio. or what you call the debt to equity ratio. So this is one of the things that we don't talk about, as I said, because we know that you covered it on level 2. And I told you that things you covered on level 2 doesn't mean that they will not appear here. They may appear, some of them. So we cover this under financial ratio analysis. But these are some of the ratios. These are some of the ratios that we use when we are talking about financial and then the operational gearing, or what we call the financial or operational leverage. But the examiner will not ask you to compute the ratio. Otherwise, he will be taking you directly to the ratio. And this is what they will examine you, where you will be asking you to assess the impact of the new investment. So I want you to learn this, but I don't want you to understand that they are going to ask you to compute the ratio. What they will ask you for this, if it has been brought, it will be taking you to what you call the new investment. And they want you to assess the impact when you are assessing the impact of either financial or operational gearing on the new investment. The issue is on the new investments, and that differentiates it from what we know, because this is something that is going to be coming on the new investment if you have made an extra investment. In other words, they will come when they have given you the ratios, but they tell you to assess the impact of those ratios on the new investment that you have made. So you find yourself, you are already geared as a business. You are already geared. Now, but they want you to do a new investment. Remember, this new investment, you are going to look for money. We don't know whether the money is within the business or you are going to look it from somewhere else, from the different sources that we looked at. So the result, as a result of you getting a new investment, we are getting something that is new. When you are setting up a business, we are getting different cash flows because we expect to increase our cash flows, because it is going to be a new investment that is going to be coming in. So as the investment comes in, we expect even the sales to increase. But don't forget that you are already geared in the business. But as you add on an investment, you are expecting to generate more cash flows. And at the same time, you may be expected to look at for more sources. If you don't look at the more sources, maybe if the money is available, but we expect you to have an increment in the sales that you have been making. If you have been maybe producing soda and maybe you are now going into production of water, the new water production is going to be the new investment. And we expect to increase more sales as a result of the additional investment that we have made. So we want to look at the fact that we are already geared in the business. We have gearing ratio. The other ratios, we've been computing them, trying to know whether we are going to be geared, highly geared or not. But here we're already geared, but we are just adding in an investment, and you want to look at the impact of our gearing to the new investment that we have ventured into. So sales, we expect the sales to go up, the costs to also increase. Others may reduce based on whichever analysis that we have done that made us to reduce the costs. So the gearing is also going to go up, as I said, because we are going to be acquiring more funds. So The examiner might ask you for the impact of the new investment and he wants you to show methodically how to do a number that has some kind of those two things that I've talked about. So this is what we are going to look at in the next video. The next video is going to be looking at a new investment, and we are basically looking at the impact. We are already geared in the business, but the fact that we are already geared, the gearing is also going to widen because we are introducing in a new investment, and we may be prompted to look for more sources. So we are going to look at simulation number 2, that is going to be basically looking at the impact of the new investment. What will be the impact? What do you think that are going to come in? Or what will happen to the profit before interest and tax? What will happen to our contribution? Because as sales keeps on going up, even the costs, if costs remains constant, then we are okay with it, because we shall be getting more contribution. Because there are some investments that you can do that will not increase the costs. If let's say we've been producing the same products, but within those same products there are some costs that can remain constant, and we keep on incurring other costs. That's why I started by looking at something to do with fixed costs. So I want to look at the analysis. How can you be able to guide based on the impact that you have, given the fact that the company is highly geared, but you are introducing in a new investment. So let's meet in the next video as we're talking about that. But don't forget to subscribe, share to others, let them also be part of this wonderful community.